Hey everyone, welcome to another episode of Who Said What. This is the show where I take interesting comments, headlines, and quotes that caught my attention and dig into the stories behind them. You know how every week there's a bunch of headlines that grab everyone's attention and there's so much hype around them? Well, in all that chaos, the nuance, which is the real story, often gets lost. So that's the idea behind this show. Today, I've got four interesting comments for you. The first one is about the markets being overvalued. You see, I am new to the markets. Most of the things that experts, commentators, or even what my boss says tend to go over my head. This show is partly my selfish attempt to learn all the nitty gritty of the markets while sharing whatever I pick along the way. And one term I keep hearing is that the markets are overvalued. Every time the market falls even a tiny bit, this meme comes to my mind. The markets dipped again this week, which seems like the perfect trigger to talk about what the experts are saying about valuations. Here's a tweet I came across on this very topic. Sanjeev Prasad, who is the co-head and MD of Kotak Institutional Securities, wrote in a research report about markets being overvalued, and it was a digestible read. When I say digestible, I mean it didn't feel like Greek or Latin to me. He bluntly titled one section as Comedy, absurd valuations for so many sectors and stocks even now. He didn't hold back pointing out that retail investors' focus on greed over fundamentals has driven valuations to ludicrous levels. Here are some of his key points. First, retail investors seem to be throwing caution to the wind. Second, any random story about a sector or stock is enough to rally buyers. Third, investors don't really care about the fundamentals but the dip. He used charts to illustrate how narrative stocks are trading at ridiculous PE ratios. For the uninitiated, PE is a quick and dirty metric to gauge how much investors are willing to pay for a company relative to its earning. It's a handy tool, but it has its own limits. He says this: in our view, many narrative stocks have a long way to fall based on the true value of such companies. Many of them have corrected sharply in the past 3 to 6 months, but most are trading at absolutely ridiculous valuations. By narrative, he means where valuations and growth expectations are driven more by compelling stories about future potential than by current financial performance. For example, sectors like EMS and capital goods. And it's not the first time he has said this. In June last year, he said this: in our view, the extreme euphoria among non-institutional investors has resulted in, first, steep increase in stock prices of mid-cap and small-cap stocks over the past 15 months. Second, distended valuations across sectors. Before that, in March of last year, he said the same thing. Euphoria, incorrect valuation principles, unrealistic narratives are at play. The problem with valuations and why timing markets based on them rarely works is that markets don't often make sense in the short term. Valuations are a way to see how much people are willing to pay for a stock compared to its actual numbers, like profits or assets. But markets aren't just about numbers. Markets are driven by a mix of fundamentals, liquidity, sentiment, and momentum, each of which can behave unpredictably. Akash Prakash of Amansa Capital adds another layer to this conversation. He recently wrote about global markets, voicing concerns over elevated valuations, not just in India, but particularly in the US. If you look at the CAPE ratio, the only time it has been higher was during the dot-com bubble of 1999 to 2000. On alternative valuation metrics like price to book or price to sales, we've already crossed those levels. Now, what the hell is CAPE ratio? Like how the PE ratio compares a company's stock price to its annual earnings, the CAPE ratio smoothens out the earnings over a 10-year period and adjusts this for inflation. This makes it less prone to short-term fluctuations and a better measure of long-term value. In simple terms, it's a way to judge whether markets are running too hot or too cold over time. Here's how the Indian CAPE ratio looks like, all thanks to Professor Rajan Raju for this data. Prakash argues that high starting valuations significantly diminish the chances of robust long-term returns. He paints a stark picture. Can you really make good long-term returns from US equities when your starting point is arguably the most expensive in history? Financial history suggests this is a bad bet. Interestingly, Sanjeev Prasad had also discussed valuations in a CNBC interview some time back. He pointed out that headline valuation numbers can be very misleading. For instance, he explained,
because about 50% of the valuations, again, it's a very misleading number, because about 50% of the net profits of the index comes from lower PE sectors. 27% comes from banks, about 5% from metals, 19% from oil and gas, which are, trading at between 13 to 15 P.
He didn't mince his words about narrative stocks, saying many mid-cap and small-cap narrative stocks have corrected by 20 to 50%, but their true value is often only 20 to 50% of their current market prices. There's still a long way to go for these to align with reality. So are the markets overvalued? I am not an expert, but both Sanjeev Prasad and Akash Prakash make compelling cases that many sectors and stocks, whether in India or the US, are priced for perfection, if not beyond. If you look underneath the indices, there's a lot of blood. What do you think? Are the markets overvalued? Now, in the second story, I'll talk about cigarettes being smuggled to India. So the Indian Express recently published an article saying that ITC wrote in a letter to Directorate of Revenue Intelligence saying that the smuggling of misbranded cigarettes from Southeast Asian countries into India is causing an annual tax revenue loss of 21,000 crore, apart from helping finance terrorism. I tried to find this letter but I couldn't find it anywhere. But here's what I did find. ITC in their last annual report had highlighted this number. They said that it is estimated that illicit trade causes an annual revenue loss of approx 21,000 crores to the exchequer. With respect to other tobacco products as well, the revenue losses are significant since 68% of the total tobacco consumed in the country remains outside the tax net. India smokes roughly 12,600 crore cigarettes annually. However large this number may seem, India's cigarette consumption is relatively low compared to some other countries. For instance, China's cigarette consumption dwarfs India's by a wide margin. This leads to an interesting statistic. India is the second largest producer and consumer of tobacco in the world. But here's the catch. China produces more than half of what India does. China's sheer scale in both production and consumption of tobacco makes India's numbers look modest by comparison. The 21,000 crore rupee annual revenue loss due to smuggling isn't just a number. It underscores a systemic issue rooted in India's high tax regime on legal cigarettes. Tax rates on cigarettes in India are among the highest globally, accounting for nearly 50 to 60% of the retail price of most cigarette brands. This creates a massive price disparity between legal cigarettes and smuggled ones. Smuggling becomes a lucrative trade when the price difference is stark. For context, smuggled cigarettes often evade duties entirely, allowing them to undercut legitimate products by 30 to 40% in price. This has dual impact. First, it dents companies like ITC whose cigarette business operates within the legal framework but competes against those untagged smuggled products. Second, it deprives the government of significant revenue, weakening its ability to regulate the sector and fund public health initiatives. So smuggling seems like a really big problem. 21,000 crores seems like a big number, but is this the real number? I don't know. Is the number larger than this? Maybe. How did they even come up with this number? I have more questions than answers on this. In their last to last annual report, they mentioned this number, 15,500 crore, and back in 2013, they said this number is more than 26,000 crore. So the annual tax revenue loss due to cigarette smuggling was more in 2013 than in the coming years? Does it mean that over the years smuggling has reduced? Like I said, I don't have any clue. Please tell me if you know. Now in the third story, I'll talk about AI, whether it's a good thing or a bad thing. This line in Sam Altman's blog post is stuck in my mind ever since I spoke about this in the last episode. We are now confident we know how to build AGI as we have traditionally understood it. AGI, for context, loosely means a machine being able to do whatever a human can. I can't stop thinking about why he would make such a statement. More so because I'm a little terrified because I don't fully understand what the hell he is going on about. Luckily, I came across a post by Ethan Mollick, a professor at Wharton, titled Prophecies of the Flood. And now I can't stop thinking about how brilliantly he has articulated the good and the bad side of AI agents and all the hoo-ha around it. Ethan begins by highlighting how AI leaders have hinted that we are closer to AGI. Many of them claim to have unique insights into the future of AI. Basically, industry insiders know everything because they are closer to it. Here's what he says. Dismissing these predictions as mere hype may not be helpful. Whatever their incentives, the researchers and engineers inside AI labs appear genuinely convinced they are witnessing the emergence of something unprecedented. This brings me to another perspective I came across, a blog post by AI Snake Oil. While Ethan believes dismissing predictions is unhelpful, this post questions whether industry insiders are even credible predictors of AI's future. Broadly, here's what they say. They argue that it's way too early to say AI progress is slowing down or that making bigger models is over. Sure, companies like OpenAI, Google, and Anthropic have hit some walls with their next gen AI models, but that doesn't prove scaling is dead. Just that easy wins are gone for now. What's frustrating though is how quickly the narrative shifted from scaling will lead to super intelligence to scaling is over, and now we are all about inference scaling. Inference scaling, by the way, means optimizing how AI models use existing knowledge rather than just making them bigger. The authors say this flip flop shows that you shouldn't trust what industry insiders are predicting about AI's future. And here's why the post says you shouldn't trust them. First, they've been wrong before. Like when everyone was hyping up self-driving cars but full automation still hasn't happened. Second, they don't actually have some huge secret advantage. Even though insiders have access to data about their own models, it's only useful for a few months. That doesn't make them any better at guessing what's coming years down the line. Third, these insiders have their own agendas like fundraising. Now coming back to Ethan's comment that dismissing their predictions may not be helpful. He backs that up by showing various examples. For example, Google's DeepMind was able to give him a 17-page report with 118 references on entrepreneurship. And Ethan's a professor at Wharton himself, and he said this. It is a bit shallow and does not make strong arguments in the face of conflicting evidence. So not as good as humans, but better than a lot of reports I see. Still, this is a genuinely disruptive example of an agent with real value. Researching and report writing is a major task of many jobs. Now that's a big deal. There were various other examples that he gave. One other that I found very interesting was when he pointed out how OpenAI's new model O3 has sparked intense speculation by surpassing major benchmarks. It's part of a new generation of AI reasoners designed to take extra time to think before answering, significantly improving problem-solving abilities. On the graduate level Google Proof Q&A test, O3 scored 87%, outperforming human PhDs who averaged 34% outside their specialty and 81% within it. On the notoriously difficult frontier math problems where no AI had scored above 2%, O3 managed 25%. As we grapple with AI's implications, perhaps the bigger question isn't whether AGI is near, but how prepared we are for the disruption it might bring. Now in the last story, I'll talk about if the world is coming to an end. See, the world is constantly changing. There's a stark difference between 2015 India versus 2025 India. But why the hell am I saying this? Ezra Klein, a New York columnist and the co-founder of Vox, recently wrote a piece in NYT saying that the world is breaking down. Here's how the intro starts. Donald Trump is returning. Artificial intelligence is maturing. The planet is warming and the global fertility rate is collapsing. To look at any of these stories in isolation is to miss what they collectively represent. The unsteady, unpredictable emergence of a different world. Much that we took for granted over the last 50 years, from climate to birth rates to political institutions, is breaking down. Movements and tech that seek to upend the next 50 years are breaking through. He's basically saying that there are too many big changes happening all at once. Trump returning, AI boom, global warming, and the fertility rate going down. All these events put together, he says, is extremely frightening. He tweeted this. Now I agree, things are changing and it does feel like we are living in whirlwind of events. But here's my question. Isn't the world constantly changing? What makes this moment the moment to declare the end of stability, the beginning of chaos? What makes this change so fundamentally different? Here's a tweet I saw on similar lines. The tweet said, the world is changing all the time. It's only people who are fully attached to only one particular worldview who don't see it. To claim that the world has remained somehow stable and unchanged for the last 50 years is just ridiculous. Think about the early 2000s. The 9/11 attacks upended global geopolitics, sparking wars in Afghanistan and Iraq that reshaped the Middle East. The 2008 financial crisis sent shockwaves across the world, collapsing economies and leading to unprecedented government bailouts. At that time, people genuinely thought that the global financial system was on the brink of collapse. Or take 2020. When the COVID-19 pandemic hit. Overnight, the world changed in ways no one could have predicted. Borders shut, economies froze, and millions of lives were lost. Yet, here we are. Ezra warns about the rise of AI and its implications. But haven't we been through similar fears? In the 2010s, people worried automation would wipe out entire industries. Remember when everyone thought self-driving cars would make truck drivers obsolete by 2020? It didn't happen that way. AI is advancing fast, sure, but isn't that just another chapter in the tech evolution that's been shaping the world since the Industrial Revolution? This brings me to the idea of polycrisis, a term popularized by historian Adam Tooze. But not everyone likes this term. Historian Niall Ferguson said the polycrisis is just history happening. Now let me explain what polycrisis means. Unlike a single crisis, a polycrisis involves multiple interconnected crises that amplify one another. Adam describes it as a situation where the whole is even more dangerous than the sum of the parts. Think about it. Global warming isn't just an environmental issue, it's tied to food security, migration, and political stability. The rise of AI isn't just a technological shift, it's reshaping labor markets, geopolitical power, and even how we perceive reality. Fertility rate declines aren't merely a demographic concern, they have long term economic implications for growth and social security systems. Each of these crises might be manageable on its own, but when they interact, the complexity can feel overwhelming. For instance, climate change can increase migration pressures, which in turn stress political systems already grappling with the economic disruptions caused by automation or declining populations. It's the entanglement of these crises that makes this moment feel uniquely unstable. This helps frame why Ezra Klein's piece resonates. It's not just the magnitude of individual changes, it's the way they're all happening at once, creating a sense of cascading instability. The world might always have been in flux, but the speed and interconnectedness of these crises make it harder to navigate it. Yet, it's worth remembering that the world of 2015 doesn't look like the world of 2025. The world of 2000 didn't look like the world of 2010 either. From the Industrial Revolution to the rise of Internet, humanity has always navigated transformational moments. What's different now might be the speed and scale of these changes. So maybe Ezra is right about one thing. This is a wild decade. But at the same time, isn't this just another chapter in the constant evolution of human history? Thanks for making it so far. Please let me know what you think of the episode. Akash Prakash. मैंने क्या बोला? China's sheer भाई बहुत हार्ड है भाई. ओके ठीक है. China's